All right, ladies and gentlemen, I am in control of the microphone, and you boys apparently have to share. Let's kick today off because we are running a little bit long on time. Hedley, I'm going to throw the first question to you. Now, Lion Selection Group currently has exposure to gold, copper and phosphate projects, but overall, your company is largely sitting in cash. In fact, when I went through your books, 40% of your assets are allocated to cash. Now, thankfully, the RBA raised interest rates yesterday, so that cash is worth a little more. But surely, wouldn't that cash be worth more invested in a miner for your shareholders? What is it going to take to get that $40 million out of the bank and into a miner?
Well, that's an on-the-spot question, isn't it? Thank you, Shae. Should never have expected that from you. There's actually a fair-sized receivable there which will turn into cash in January, February next year. So the number is probably significantly higher than 40%, but I think the question still stands, are we investing and what in? And I think probably our biggest hesitancy at the moment is there's a hell of a lot of volatility in the equity market generally. We're seeing it in commodities as well. So is now a great time to be moving from, let's call it 90% cash, which it could be, into 90% equities in junior explorers and developers? I don't think it's time to be aggressive. So what are we waiting for? Well, opportunities present as the equity market volatility goes up and down, and it's on the downswings that we really want to be putting that money into the market. And there's a hell of a lot of opportunities to do that. So each of these companies, which junior companies have to raise money in order to go on, in order to do their work, and that's a very, very different funding proposition to raising debt or to depending on cash flow. If you don't have cash flow, it means you're dependent on investors, and that's where we feel that the opportunity is strongest for us.
I look forward to your new opportunities. John, I'm going to throw the next question to you. Pass the mic down, like pass the parcel. So unlike Lion Selection Group, who has a large cash allocation, Lowell Resource Funds Management has a small cash allocation. Your firm looks to be quite evenly dispersed among base and battery metals as well as critical metals. However, your fund has nearly a 50% allocation to gold. Now, a little bit of trivia here for the crowd is spot gold finished October down, the 7th month in a row since gold, 7 months in a row, but also too, it's the first time in history that gold has closed down 7 months in a row since gold has been freely traded. So broadly speaking, if gold is struggling and gold equities are struggling, why does your fund have such a large exposure to this precious metal right now?
Thanks, Shae. Another good question. Look, I think one of the answers to that question is that we're focused on the junior resources sector, and gold is something that the junior companies generally do well. It's definitely within their capabilities to develop most gold deposits from a funding point of view and from a technical point of view. But I think from our strategic point of view, we like to be counter-cyclical. So we have realised some very good investments in things like lithium recently, and some of that money, not all of it, has gone back into gold opportunities. So who knows what's going to happen to gold, but we have seen in the past that gold companies can do well even in a depressed or soft gold market if they make the right discoveries and, you know, develop the projects in the right way. And I think Northern Star in particular is a company that did really well through a period that was very tough for the gold market. So we're looking to find the next Northern Star, if you like.
Well, we'd like to see what the next Northern Star is. I'll get you to pass the mic to Dan, you're a mind reader. Now, Dan, as John just mentioned, pure asset management is also technically counter-cyclical when it comes to the investments that they make. Essentially, your fund aims to give resource companies, get them over that financial hump until they start generating revenue. And of course, you charge a hefty premium for this, which I believe your investors are quite happy about. Now, this successful strategy has worked for you. However, by the time these companies come to production, odds are their share price is in the toilet. They've probably maxed out their debt facilities with other providers. They're basically the kind of company that if they went to the market, their capital raising wouldn't do well. These risks don't deter your company, and I believe you put it to me as if you have a line of sight of future cash flows and being 6 to 12 months from production, these are key parts of your decision-making process, which I would say makes pure asset management a contrarian indicator in the market. So tell me two things. Who was coming hat in hand looking for money 18 months ago, and what kind of companies are knocking on your door right now?
It's very well put, Shae. Yeah, no, we are definitely a contrarian style of fund. I think it's mostly because we offer a hybrid credit offering. It's, we take a convertible note, which was always seen as quite nasty, particularly in the resources space, and we break it down into its core components of straight debt on one side and options and warrants on the other side. And the reason we do that is it gives the company a lot more flexibility. It gets us a good return for our investors as well, as you kind of pointed out. But at the same time, what it is far less dilutive than an equity raise. And so often when companies are coming to us, it's because they have a requirement for capital. And it's often that last sort of $10 million chunk that's really tricky to get. Brokers don't necessarily want to do it, it's a bit small for them, but they need it to get over the line. And so we like to be that last piece of the puzzle. So 18 months ago when we kicked off the Resources Fund, we had a lot of demand from oil and gas companies, which fast forward 18 months and we're now in an East Coast gas supply crisis. So we invested into 2 listed gas companies that will now be the next 2 major producers on the East Coast. So that was good timing for us. We also saw a lot of inbound from critical minerals companies. Now that's a little bit different, but we've also seen critical minerals prices in terms of things like tungsten remain quite elevated, and tungsten is probably one of the best performers in the commodity space this year. And again, that market has done quite well on an 18-month view. What we're seeing a lot now is gold companies, copper and nickel. So I would probably be getting 8 to 12 phone calls a week from companies in that space. We made our first investment into a gold and copper company in the middle of this year, and there's certainly no shortage of projects out there. There are a lot of juniors in the gold space, and they do it quite well. But there is a big need for capital, and that's where we jump in.
As we've seen today, there are some copper and gold juniors that are desperately hunting for capital. I'm going to get you to pass the mic back to John, actually, shaking up the rotation. All right, now for a little bit of context for the crowd, capital flows have changed significantly since 2021. So in 2021, across the 4 Canadian exchanges, there were 171 IPOs, raising a total of 10.1 billion Canadian dollars. So it's a big year. Compared to this year on all 4 Canadian exchanges, there's been 37 capital raisings, barely raising 2 billion Canadian dollars. Let's compare this to the ASX. So in 2001, the ASX had a blister of a year. There was another word I wanted to use, but I won't. We're a good company. The ATO had 191 IPOs listed on the ASX, with $12 billion in capital raise, and I think 58% of these were resource companies. Come this year, there's been 80 IPOs on the ASX, and there's another 8 scheduled to list before the year closes. John, my question to you is, Canada, the Canadian exchanges for such a long time have been the home of resource stocks. So what is bringing Canadian companies to Australia? Tell me, are they coming here because, suddenly our market, the Australian market, is quite friendly to Canadian juniors? Or is it that the persistently weak Aussie dollar is attracting them?
Look, Shae, great stats there, and I think that really bears out something that we've been noticing for probably the best part of 6 or 12 months, that the Aussie market in general is attracting higher valuations than the Canadian market, particularly the TSXV. And look, I'm really, I'm still searching for the answer to why that is. But the best one I've heard so far is that the Canadian market is much more volatile than the Aussie market. So we're obviously in a real downtrend in the equity market at the moment, but that extra volatility that you see in Canada means that the down cycle is much deeper, and when the lights go off, you just throw away the keys, and there's absolutely no access to capital over there. So I think while we are seeing some North American money coming into Australia, for example, the Cannon nickel takeover, which just occurred in the past week, that's Canadian money, I understand, and we're seeing some North American funds come into lithium in Australia. I think it's really the higher valuations, which is unusual, the higher valuations that you're seeing on the ASX for many different many different companies and commodities, and you're also seeing, as a result of that, you're seeing Aussie companies take advantage of that by going to Canada and joint venturing into projects that are held by the Canadian companies with very limited access to capital, while the Aussie companies have slightly better access to capital. So there's some great opportunities being taken by Aussie companies, almost in a vulture sense at the moment, in things like uranium or lithium and copper and numerous other commodities.
Excellent. I'm going to get you to throw it to Hedley. Excuse me while I'm pushing buttons. My very fancy digital notepad failed me for a moment there. Just as I was trying to take notes.
Before you go on, Shae, that question about capital flows between Canada and Australian markets, I mean, historically there's been times when valuations in Canada have been much, much higher than the equivalent companies in Australia. There was a gold premium there for many, many years, and people debated why that would be the case, to the extent that some of the larger gold companies were able to use their paper to deal into Australian projects. This was the building of Barrick and Newmont in many ways. Paying for projects, increasing their production, getting a greater premium in the North American market and growing off the back of that. That I think is reversed, and I'm not sure if that's a sentiment towards gold, or you often look at what else is going on in the markets. The feature of the last decade in Canada has been the proliferation of cannabis, which has just soaked up a lot of risk money. And lithium, has almost been missed until quite recently. John, I don't know if you reflect on that as well, but much, much bigger valuations for lithium companies here and more excitement, which now seems to be taking off in Canada, which is otherwise off as far as everything else goes. So, that volatility, I'd sort of say it's almost on or off, and not much in between sometimes. So, sorry you're asking the questions, Shae, so off you go.
I love it when people contribute their random thoughts. All right, let's move on. Now, this is a little bit of a bugbear of mine, and this is why I'm throwing it at you, Hedley, because I know our friendship can handle it. So, again, this is for context for the audience. So, mining stocks are about 1/3 of the total companies listed on the ASX, and depending on the day, mining companies represent about 20% of the market capitalisation of the entire ASX. Interestingly enough, not only is Australia a leading exporter of coal and gas, but the best performing stocks in general this year on the ASX have been oil, gas and coal. Now, recently Australian super funds have turned, using a phrase I like to call financial activists. Now, Australian super funds are quite important to the ASX. They could, at any given time, they have about 30% of our super money invested in ASX-listed stocks, which essentially gives super funds a $1 trillion problem, and that is where to put their money. Now, earlier this year, one particular fund, which I won't name, found their members demanding that they exit fossil fuel stocks, and if they didn't, they were going to take their business elsewhere. As a result, said company increased their position in a certain company to get to the board to drive change at a board level. Now, Hedley, this is my question for you. Tell me, are we going to have a two-tier superannuation system that is funds that invest based on potential profits over principles versus funds that puts principles ahead of profits? And unfairly, a double-barrel question as well. But more to the point, does this leave mining companies vulnerable to financial activism for super funds?
No, I think the high-level answer to that is yes. I think there's a material risk of activism of sorts, which mining companies are vulnerable to. And the reason why I would say that is that mining companies seem to operate in the dark, in the dust, and a long way from where most people live. So if you asked any punter, in fact, better still, if you ask any primary school child, what's your perception of mining? Their answer is more likely to be that it's filthy than that it's clean and it's necessary. So if you operate in that sort of hidden way of being, and people who don't understand whether you're necessary or not, it's difficult for them to make informed decisions. Now, let's extend that to super funds and things like that. We're seeing more and more activity from super funds, which are, I suppose, pushing agendas is one way to say it. Being in or out of fossil fuels is one. I suppose the way that they engage with their investments, engage with the financial markets is another. And when you've got a lot of money which is flowing in, you can offer a fallback, if you like. So where you take the money from can be important to a company, and if someone's offering more and more, then you tend to pander to whatever it is that they're throwing at you as well. So I think there is definitely a worrying trend, and I'm aware of the example that you're making, but again, I'm not going to name it either. Only to say that capital markets, have for hundreds of years, in fact probably longer than that, matched the pools of money with the best investment opportunities. That's supposed to be where the efficiency exists, that the best investments get the capital and that it's the mechanism which sorts it out. That's been based on return and always has been, and if people don't want to put their money into something for an ethical reason, then they don't have to. What concerns me is when you start to see funds or individuals which are investing in something which don't have a financial return in mind, and they're seeking an outcome with the company which is could be detrimental to other investors in there. Because it doesn't matter what you do with your own money, you can do that in your own time, but it's when it starts to affect other people, particularly their livelihoods, that I think that becomes quite risky. So I don't know if that's quite as provocative a response as you're after, but if there was a part B, you might be able to steer me down a more provocative pathway. Or
I'll come up with something like that and put it on YouTube. All right, the final individual question is for Dan today. Now, speaking of provocative, we're going to talk about ESG. All right, so PwC has declared that ESG is no longer optional for mining companies. It's the minimum operating standard. So in order to meet these ambitious net zero targets, globally the mining industry needs to double capital expenditure to $160 billion per year for the next 20 years to meet these goals. Now, all you gentlemen know that there's just not that kind of money flowing into the mining sector right now. Yet, regardless of funds, the entire process when it comes to exploration, from discovery to production, is being weighed down by increasing ESG requirements. Authorities are reluctant to approve permits for fear of a public backlash, and banks are reluctant to fund mines because it makes meeting their internal ESG goals harder. So tell me, Dan, because this was something you were quite passionate about when we spoke, how do we achieve net zero targets if ESG obligations are making the process increasingly difficult and banks are reluctant to fund? Where is the balance between necessity and ideals?
That's an excellent question, Shae. Hopefully we can get a little bit provocative. But look, I think there's an unfair application of ESG, and it's very selective in where it's applied. So there's a big focus on E. There doesn't seem to be much focus on S and G wherever you go, and you can say that about any industry, but it's particularly easy to apply it to mining because it is seen as dirty and filthy and out of sight, out of mind, and every primary school kid thinks it's terrible. But we're also missing the point of everything that we are doing in our lives, and everyday activities depend completely on the mining industry. So there is a strong requirement for it, but when I look at specific examples in the mining industry where we're going down the battery route, reducing emissions, that's fine. Nobody seems to talk about the ESG implications of cobalt and the fact that 80% of it comes from the Congo and it's mined by kids. It seems to go under the radar of a lot of ESG policies. So I look at that and I sort of frown a little bit and think, well, it's not really being applied equally here. So I think on a lot of these applications, you need to think about it. Financiers and governments alike need to think about it more equally. And I think there needs to be a recognition from all parties that there is a strong need for mining, a bigger need for mining than we've ever had in our history. If you look at what are stated policies of governments around the world to get to 2030 emissions targets, there are not enough commodities in the world to reach what we are intending to do. So the IEA, International Energy Agency, very well-respected organisation, put out a report at the start of September, and it was almost a report of exasperation. It was a report that basically said, look, we're dumbing it down. This is how many mines we need in the next 7 years to hit 2030 policies. And it was something like 55 nickel mines, 50 cobalt mines, 45 copper mines, before we even get to how much lithium we need. So there's a huge requirement to move this way, but the lack of interest in the sector is increasing. If I look at when I first started in the financial industry or in broking in 2007, mining teams were the biggest teams by far. They had the most staff, there was the most interest, there was the most deals, there was the most capital raised. Now you're lucky to get one person covering the entire sector at a broker. It's become really, the dirty sector to cover even from a financial market perspective. If you look at the multiple of ASX 200 companies, ex-resources, he trades at twice what the resources companies do. If you look at the number of analysts covering the sector 10 years ago, it was 1.4 analysts per stock. Now it's 0.4 analysts per stock. The outflows of capital have been huge, and it's because of a whole variety of reasons. Banks have invested a lot. Retail banks, I'm talking about, invested a lot in the sector historically. They haven't always made great returns. There's been some big project blow-ups. That combined with ESG overlay has meant that they have walked away from the sector. Then you've got mid-tier, smaller mid-tier financiers that are moving up the scale, so they're doing bigger facilities. And then there's a real gap at the junior end, which is where we're playing. But what it is meaning is the cost of financing is going up astronomically across the space, and that will only flow through into the cost of the end product. So we have this situation now where we have pretty extreme energy inflation. I don't think that goes away. I think that will remain, and I think it's because of these policies that we've got at the moment. We can turn around though if the governments get off their backsides basically and start to approve a lot more projects. We saw the Victorian Premier yesterday whinging about having no gas in Victoria, but he's not allowed gas exploration for 15 years. It's quite bizarre. So we need a lot more development on the political side, a lot more understanding of the requirement for mining. I don't think people have really a good understanding of how much more commodities we will actually need. And just finally, if you look at the LME commodity supplies, they're at all-time lows. We're heading into a recession. Commodity prices have come off hugely. By the time we get through this next hiccup, I think commodity prices will have the biggest run we've ever seen. You can forget about the last 18 months. I think the next 3 years are probably going to be, coal might hit $1,000 a tonne, who knows. But I think it'll be a super cycle the likes of which we've never seen because of these reasons. So that might be a bit long-winded.
No, absolutely. I like your answer. All right, ladies and gentlemen, we have 2 minutes and 45 seconds before they turn the lights out, but I reckon we can stretch it 1 or 2 minutes. And the reason is I want to talk about lithium. Now, I have pretty much a question for everybody here on lithium, and the order will be Hedley, John, and Dan. Dan, tell me, has Elon Musk pumped up the price of lithium? This is going to be funny, and I ruined it. Has Elon Musk pumped up lithium demand to ultimately drive down the lithium price?
It's even funnier because I think you just called me Dan, but...
I did, I'm so sorry.
I can see very clearly the fundamental for lithium going into batteries, need to produce more lithium in order to make more batteries. And Dan went very close to, you also need to mine a shitload of a lot of other stuff in order to go into those batteries. And that might very well hold back the consumption of lithium. So let's not get too far ahead of ourselves in terms of what will be required 23, 24, 25. It's difficult to extrapolate the price from where we see it now smoothly through those periods. And small markets which grow strongly often have a lot of volatility in them. Elon Musk very famously quoted for saying, I think via Twitter, which he now owns, so he can say whatever he wants, bring me lithium, you'll become rich. Go and look for that. I don't know, Shae. I tend to look at the other side of the coin a bit more than maybe a few others, but and I get in a bit of trouble for this. I mean, a lot of people approach me at conferences and tell me I'm a dickhead because I don't think that the lithium price is going to triple in the next 10 minutes. But is it in Elon Musk's interest to see a lot of entrepreneurs get rich for bringing in lithium? No. Is it in his interest to engineer oversupply by really encouraging people? Well, yeah, definitely, because he wants a lot of it to make batteries. So I guess, we've seen a lot of exploration, there will be development. I think supply will increase quite rapidly to meet that, and you might be shocked by how much the demand is volatile on the other side as well. Hedley, out.
Excellent answer. All right, I will get you to pass all the way down here to John. All right, John, from where you sit, do you believe that lithium is in a hype cycle? And furthermore, your fund is almost nearly equally weighted to battery metals and fossil fuels. Are you hedging your bets? Or is this balancing short-term opportunities against a long-term one?
I'll deal with the first question first. The other week we saw something that I've never seen before, and that was an offtake agreement being done by a serious fund out of North America, which did an offtake agreement for lithium on a soil anomaly. And I can't remember that for any other commodity, full stop. So I think the short answer is yes. When you see lithium price of any commodity go vertical like lithium has, yeah, you really worry about how fast it's going to come back down. On the second question, look, you know, I think we are hedging our bets in terms of short term. The prices for fossil fuels, old fossil fuels, are very, very strong. But I think, you know, as Dan alluded to, there's been serious underinvestment, and a lot of fossil fuel companies don't actually want to invest in their own business, and that is just storing up. That is just prolonging the lack of supply and storing up problems, even greater problems for tomorrow. So we see high prices now. Very interesting, you know, $1,000 coal. Why not? Look, coal companies are doing that's the last thing they want to do is invest in their own business. They want to go and buy a copper mine. They want to build a solar farm. They want to build a wind farm. And that comes back to your point about driving the drivers from superannuation funds and other investors on ESG, if you like. So sorry, I better leave it there. I think we're running out of time.
Excellent answer. Thank you very much. I'm very impressed with that. All right, Dan, one more final question for you. You get the final say today. Lithium has been sucking the oxygen out of the market. All the capital has been flowing to lithium. Tell me, what minerals have come at the expense of this? Where else should investors be looking?
Look, if you want to play the battery side, I still think the biggest supply and demand imbalances are in tin and copper. And I think that's where we'll really see over the next decade. You know, I think that that lack of investment that we've seen and the lack of new and dependable grades that we're seeing as well in those exploration results that we're seeing probably means that those two commodities for me will probably be the best performing in that sense. But I think the one that people always forget about, and if you want to build a wind turbine, or if you want to make a solar panel, you still need a lot of steel. And nobody's investing in coal, and the demand keeps going up. So when I say $1,000 a tonne for coal, we might really get there. We saw $650 this year in met coal. That wasn't that long ago. So I think that's probably not a better place to park some money if you can withstand it.
All right, gentlemen, this has been a fantastic session. Thank you very much for telling me that there were no rules today. John, thank you for being here. Dan, it's been fantastic, and Hedley, it's always a pleasure. Ladies and gentlemen, that brings our investment, what is attracting investors within mining and resources and why. That brings our session to a close today. I believe there are some events happening around, so you are welcome to stay for that. Thank you very much.